these orders, saying, well, how are they coming in? How are the orders coming in? And are the orders staying at a certain place? So if you get, we'll just look at 0 to 100. If you have 5 orders down here, 6 orders here, and then 10,000 orders up there, what does that mean? Or does it mean anything? And I'm reviewing what they found out in Japan is, yeah, it does. It does mean something. And it means that we have a likelihood that this move is going to continue. Okay, it's just a likelihood. So as we're looking at, let's go back to your book, and you're seeing on the top, resistance setting up. When resistance sets up, what you'll find is that price will stay high in the bar. So if you could kind of build the candlestick with one order at a time, what you'd find is that if you were putting them in slots, you would keep putting them in at the top. But they'd be buy orders. Now what happens if you have buy orders coming in, but the market isn't going up? Well, it means that somebody keeps selling. What happens when people are selling? The market goes down. So when I asked before, well, what do you do when there's buying? Well, the answer is, I don't know. It depends on if there's enough sellers to cover it. Because if there aren't enough sellers to cover it, what's price just going to do? Explode. It's going to explode to the upside. It has to. Supply and demand. So as we focus in on these small chunks of time, we're literally able to see, are the orders coming in at the top of the bar? And do they keep coming in at the top of the bar? And is price going up? So all that stuff that the Japanese researchers looked at, we can make into one nice line and then do stuff with that. That's the goal here, is to take the real action of the market and distill it into a tradable opportunity. Doesn't require much time at all. So look at the next, forgot I had my slides back up. Ooh, look at that. Okay, so that's Hercules. For those of you who haven't seen it. And the range really is arbitrary. It's just something we came up with. It wasn't based on research. The range wasn't. It was simply there because it's easy. Everybody can count to 10 who has all 10 fingers, right? So we figured, okay, let's base it on 10. We wanted to make it fit into our own biases, how we've been brought up. We don't need to make this any harder than we have to. Yes or yes, right? Okay, so yes, it'll be in. So we're sticking with the range 0. This actually only goes up to 9. If it pegs out at 10, it's just at the top of the range. Actually, what happened is we found out that was so rare that we just decided to go to 9. What you will see on this screen when all of these buttons are checked is a big old mess, right? You just have a bunch of lines on the chart. But I think everybody knows that if something is from 0 to 10, if it's high, that's good, right? That's strong. If it's low, well, that's bad. We want our bank account to be high, not low. We want our kids' test scores to be high, not low. Okay, so that's literally, that's the reason why we design it this way. And we had to do some funky stuff with the math in order to get it this way for you. So what we're looking for here is the ideal scenario, and we'll talk more about this. What we want is to be able to come in, sit down, and get back up. We don't want to have to come in, sit down, and wait. And wait. And wait some more. Now, it's not to say that you can't come in, sit down, and get up 2 or 3 times a day. It can be quick. That's the idea here. So, it's as we make this beta version better, there'll be more indications on the chart. But if you look on the left-hand side there, where you have the list of numbers, you've got the US dollar, euro, pound, chief, Canadian, all those. Well, you see that one of them on there, in this example, is the Australian dollar. It's set as high. What that's telling you is that not only is the strength high, but it's been in the top end of that range for a while. So when somebody's putting orders in, they're putting them in at the top. And they're putting them in at the top as buy orders, not sell orders. Because if they were coming in as sell orders, the graph would be going down. So all of that stuff is distilled here for you. So you can look on here, see, one of those says high. Now the ideal scenario, which you can see on the screen is the blue line at the bottom, is to have one also that's low. Now, this gets back to the fundamentals of the currency markets. Why is it important to have one high and one low? Anybody shout it out? You have to sell one to buy the other. Exactly. Okay, so here's the currency market. You have the Australian dollar against the US dollar. Those of us who have been in the stock market or have been in the futures market, we're used to trading IBM, or you're buying IBM, or you're buying soybeans. It's one thing. You have to remember in the currency market that it's always an exchange rate. If we were all going to go to Australia, we would have to take our dollars and make them into Australian dollars. Now, we could probably get by while we were in Australia with US money, but it'd be frustrating, and believe me, I did it when I was over in Saudi, and it's a headache. Cab drivers don't like to make change in US dollars. So it'd be convenient, right, to make the exchange. Well, that's really the genesis of the Forex market in general. After World War II, you had more globalization, you had companies trading across borders. Hey, I need to have an easy way to take my dollars and turn them into pounds. And we need to have some rules here, because remember, there's the fish over on the other side, and I'm going to swim over there, flop over on the ground, come in there, and chew them up. So we need to at least have some, gentlemanly rules for eating each other. So you had Bretton Woods Agreement and other things which have fallen apart and come back in. And in the end, it really is, amazingly enough, these people are trading billions of dollars on a gentleman's agreement. It's a handshake. You do what you say you're going to do, I'll do what I say I'm going to do. I mean, the futures markets have worked like that for hundreds of years. You go into Chicago, you've got 50 guys named Vinny in there trading, and it's all, you do what you say you're going to do, and I'll do what I say I'm going to do. So with these two pairs, we can't just focus on one. And this is what was revolutionary about what these Japanese researchers did, in my mind. Because now, if this first currency is strong and the second currency is weak, I can expect that. And they've got a lot of math and stuff to back it up. But again, small windows of time, less than 30 minutes. I like to use 5 minutes. Again, sit down, look for the opportunity, get up. What does this mean? It means we're not looking for huge wins. That's the most important thing. Your risk can be very small, oftentimes 10, maybe 11 pips. As far as a gain, if I'm 20 pips to the good, I've got most of that position off. Because I don't know if guys like me are just trying to eat other guys for lunch, or if the market's really moving because the other guy is coming in. Because remember, I'm focused on the snippet in time. If this currency pair is weak and this one is strong, it depends. This is when we can get into some gray areas. So let's talk about what these mean. What does it mean to have an Australian dollar strong? What does it mean to have the US dollar strong? We're taking all of the currency pairs that the Australian dollar trades against, and we're looking at them and seeing if they're continuing to go up. Because we know